Hi everyone, thank you for watching our second episode of our YouTube channel. Today we would like to discuss the topic of interest rate and gold. My name is Angel C. I am a professional trader for the last 10 years, and we have Colin Bennett here. He is a metal analyst from the finance industry. And he has been, writing. He had been writing for CrossTheStreet.com for the last several years, and his insights is very invaluable. So I'm very happy that you can join me for a conversation today. Hi, Colin. How are you?
Hi, Angel. I'm good. And yourself?
I'm good. Last week we talked about why should people own gold, and why gold is a relevant subject for investor these days. So I would like to expand on the whole topic, and I'm very excited to get into the whole thing about interest rate, what's been happening since 2008, what the Fed did the last 3 weeks in forms of lowering interest rate to zero and printing about $2 trillion for the PPP program and other rescue efforts because of COVID-19. And, all that has so much to do with, world currencies, as well as gold becoming a more prominent investment for a lot of sovereignty and individuals. So maybe you can tell us a little bit more about it. I know you have a presentation for us. Very excited to kind of get your take on all that.
Yeah, it is very interesting, all the the policy responses that the Fed is throwing at this monetarily. They as you've seen, the metals have performed quite well, especially since '08. There was a brief pump up, and then it fell down once everybody kind of thought that they were going to be able to save everything. But where we are now is interest rates are real interest rates are negative, and the real interest rates are good for gold because gold is a zero dividend asset. So as rates go negative, owning just gold is better than owning a fiat currency that's being depreciated. So the policy response in this crisis is really interesting. Most people never really thought negative interest rates were going to come to the US. They cut it to zero, and I think the next, probably it could even be sometime in the next few months that we go negative here. So earlier, I think this week, Minneapolis Fed governor stated that, negative interest rates were a good thing for them. And we've seen how it's gone in Japan and other countries. And I beg to differ that that's not really a great thing. So that's partly why you'll probably see gold continue to have some wind behind its sails in the next little bit here.
Yeah. So let's set the premise here. U.S. Has a lot of debt, and the debt's only been piling on for years and years since 2008, with the $800 billion bailout package to the banks, to right now trillions of dollars pumping into various programs. And in between, there were efforts to increase interest rates. But with so much debts going on, happening in the corporate markets, raising interest rate even for a quarter point seems to have a very negative ripple effects on corporations and the whole economy as a whole. So I think we're talking about a lot of debts going on, and I think interest rate and gold has so much to do with all that situation. So maybe your presentation can tell us a little bit more about all that, right?
Absolutely. And what you'll notice is that over these last several years, asset prices have been abnormally high. And that is due to the liquidity that's being injected in the market, as you've discussed, and interest rates being low. Mm-hmm. Because if interest rates were anywhere near normal, which is 5 or 6%, I doubt the stock market would be anywhere near these rates, or you wouldn't see all the building going on around you. In different areas of the country, there's a lot of building and new businesses that have popped up, but how many zombie companies are there in the S&P 500? There's only, I think there's 15 or 20% that even have positive EBITDA. So, when you see these crises come, when you have the little pin that pricks the bubble, it's just a domino effect. And that's why you see all these bailouts going to the big companies, but it's harder for that money to get down to the smaller companies because, you know, there are systematic risks. But speaking of these historic low interest rates, this is a chart I found from the Bank of England and some other sources that if you look at the short-term interest rates here, we're at 5,000-year lows. We've never had interest rates this low in history. You can see the little blue line there,
Mm-hmm.
you know, zero and soon to be under that, you
Mm-hmm.
know, chart, it'll be negative. And those all coincide with gigantic bubbles. You know, I mean, you see the gigantic spike there, uh, you know, in, I think that's probably 1987, where everything's very high with rates, or in the 80s, and then it crashed, and then we've seen, you know, the volatility along those lines. But
Mm-hmm.
asset prices should never be this high in many metrics. So that's that chart.
Mm-hmm.
And speaking of gold and interest rates, this is from a few weeks ago. You can see the performance in these fiat currencies of what gold has done in these fiat currencies. So if you look at the very bottom of the average, there's only two currencies out of all of them that are not double digit return since 2005.
Mm-hmm.
And if you take it from 2000, gold is beating the S&P 500. The only way it doesn't beat S&P 500 is if you add dividends in. So that tells you a pretty good story about gold. If you just own it and do nothing, you're already going to be beating the market pretty much.
Yeah.
So you get at some private wealth manager or something and they take your fees, you know, it's not even that much different.
Absolutely.
So,
And, you know, this chart really shows in any currency denomination, there is a very strong return for just owning gold. And there's no, you know, there's transaction fees and buying gold in some places and some places don't. But, you know,
sure.
but in a nutshell, it's still a little bit less than your financial advisor will charge you for keeping your money.
Absolutely. And in these additional slides, you can see that in the Aussie dollar, we've just hit all-time highs in the Australian dollar because their policies are very similar to ours. They just responded the same way we did just before us. So they're going to keep pumping money into the system and making interest rates go lower and lower. And what you're seeing in oil, I think, is a very good possibility in gold, but in the opposite direction. In oil, there was, you know, you got negative oil, but we're going to get to the point here in gold where it may go no offer and oil was no bid. So you're running a fiat system in a finite world. So there's only so many resources in the planet. So the paper futures game in any commodity only works as long as you have the item to lever it up against. So we're at a point where what you see in oil, I think, is you could see it in gold, but the opposite direction. So you're seeing that in these fiat currencies, in the Aussie dollar. This is the Canadian dollar. It's just hit an all-time high recently. Gold did. And then this is the Russian ruble. It's
Mm-hmm.
also an additional all-time high.
Mm-hmm.
And you can see that it's just going to continue to go higher as long as these banks keep printing.
So trying to put two and two together looks like, oh, look, there is your Chinese RMB. Trying to put two and two together, the lower the interest rate, well, now it's zero, but the unattractiveness of owning fiat currency has drive corporation or individual and government to invest in gold. Is that is it a good analysis, or there's more than that?
Well, I think you know, an individual should always own some metal. It's a hedge, and if you look at what's happening right now, we have a demand shock. So this demand shock is causing, you know, demand for certain items to be high, but there's no production of those items. So you're going to see certain items, you know, meat prices are about to go up quite a bit because of all these plants are closing. So
Mm-hmm.
we're going to get some stagflation most likely in this decade because you're getting a rebalancing of prices versus demand, plus all the currency printing. So you may see a decade that very much resembles the 70s because of the lack of demand, but then you have all the currency floating around the system.
Mm-hmm.
So it's that currency is going to be chasing even less goods than we have now. So you're probably going to see certain prices go up quite a bit.
Mm-hmm.
The saying that, is funny is, the stuff you don't need goes down, the stuff you need goes up. It's just, pretty common sense, I guess, but that's
Okay, that makes sense.
and you also see the euro is at an all-time high in gold terms. And this is the British pound is also becoming all-time high in gold terms. And then, as we were talking before, in the interest rates here, we have a 10-year Treasury notes now is, I believe, somewhere in the range of 0.5 to 0.7%.
Mm-hmm.
And those are probably going to go negative as well. So you might have a good investment opportunity in that over the next year or so as they cut rates even farther, and 10-year Treasury finds its way down to zero and probably negative like in Europe. So you could make a little bit of money there trading 10-year bonds. As yields go lower, the coupons become greater. So that's probably a good opportunity. But at some point, the inflation that I spoke of a few minutes ago and the stagflation of the 70s will kill bondholders.
Mm-hmm.
So this is more of a short-term type thing. But as you see, owning gold would outdo a bond at some point here in the short term.
So let's dig into this chart a little bit, because I know that the Fed has been intervening in the Treasury markets. Because there's no bid on the markets a few weeks ago, they really went into to really support the 10-year Treasury just to prevent it from going negative. Do you think that the Fed is going to keep the rate at a certain level and just kind of lock it in instead of letting it floating around? And how would that affect gold? Or do you think that it would just make it even less attractive because there's no true reflection of what the real market is happening?
I don't think it's in national interest for the Fed to let interest rates rise because it adds extra interest expense on the line item of their balance sheet.
Mm-hmm.
Not that the government really cares about the balance sheet because the Fed can just be the buyer of last resort and the lender of last resort.
Mm-hmm.
But they're going to keep interest rates as low as they can for as long as they possibly can. And that ultimately will be very good for gold because of their devaluing, fiat currencies. And treasuries are no different. It's still a paper promise that they're going to inflate away at some point. And you may gain something in nominal terms, but you're going to lose in real terms. It's not going to increase your purchasing power over time. But gold will most likely keep up with inflation and your purchasing power over time. So stagflation, I think, is the theme of the decade, and they have no choice but to keep rates low. Otherwise, they're going to basically bankrupt themselves if they don't manipulate the market and keep it where it's at.
Cool. Got it.
And then speaking of the rate charts since the early or 1950s, the federal funds rate that you see, banks and your normal checking account or whatnot, as you can see, since the 1980s, we're on a gradual path down. And like I said, there's no way for them to not let it. Well, they'll do everything in their power to keep it as low for as long as possible. And by printing all this currency and keeping rates low, they can devalue the debt that way.
Mm-hmm.
And their burden becomes less. And then this was just from last week or so, that if you look at the 10-year column, that's the real yield curve on 10-year treasuries. So if you see down there, it's 0.36%. So as we discussed earlier in this chat, owning gold at zero is beating negative 0.36%, right?
Yeah, I'm paying them. They're paying me money. I'm
To own
paying
it.
them money to keep keep their treasury. So yeah,
And
of course.
and most critics of gold argue that it doesn't pay me a dividend and there's storage costs and all that. But all of that just got negated in this, didn't it?
Absolutely.
So you can see why gold is good. And you see this chart, and I think what the big hedge fund managers and Wall Street are finally starting to see is that this stagflation that's coming in history, when we get to these turning points, miners and hard assets do well. And as you see here in the GDX, which is a gold miner ETF, so it summates many of the biggest gold mining companies into this index. And this is a chart I found from somebody I follow on Twitter who's very good chartist. His name is North Star. And as you can see, we have a 5-year base here, or 6-year base, and the GDX or so. And as you see over here in this little breakout, this is the first time in 6 years that the GDX is closed above 32, 33 area. So it's showing that people are starting to go into gold. And as oil has crashed, the input costs for these miners have pretty much crashed by 25 or 30%. So if you're a store operator and your product just went up from maybe $1,200 or so, where most of these miners break even is, to $1,700, $1,800, think about what that does to your free cash flow and your profits. And then secondly, when your input costs go down by 25%, think about the amount of money that these miners are making. They're going to be making more money than probably any company that there is out in the S&P 500. And so risk return, I believe these miners are a great setup, and commodities are at levels since not since the 1970s. So as you can see, gold, I think, is turning up for a good decade.
When you talk about commodities, basing or in such a depressed price, and gold is kind of getting ready to shoot up, are you referring other types of commodities having an uptrend as well for the next decade, or are you only focusing more on the metal side of things?
Precious metals are one, but I do think that I'm not a huge follower of uranium, but uranium is starting to show signs of life. Corn is very cheap right now, and it's starting to show some signs of movement. But I believe any kind of hard asset, things that are that can't be printed, will end up catching a bigger bid over this next decade as people try to flee fiat currencies. And I think those things will do well over the next